All right, it is 1 o'clock, so we will get started with our weekly veg oils webinar for the week of August 10th already. As a reminder, if you have any questions, please drop them in the Q&A or the chat, and I will try to get to them all after I am done sort of rambling on about what's going on in the markets. So with that, let's get started. The biggest change we really made this week was a pretty substantial cut in our forecast for soybean oil prices. I cut sort of the whole forward curve by about 5 cents. That was really in reaction to the CVR announcement that they were going to idle their plant and then pause the development of their second plant. CVR is obviously important, and any capacity is key to our outlook, obviously. But I think it's probably just as important that this is sort of the first big one that has made an announcement that they're slowing down. And given that fact, in sort of the fact that now there's kind of a line in the sand where renewable diesel producers are saying, hey, at these prices, we're just not going to make enough money to open up. I think there's one of two ways that this works. Either soybean oil prices have to come down a bit to where renewable diesel production is profitable, or we'll get more of these announcements. And so that's kind of what triggered the cut and sort of the thinking behind the cut. Despite the cut, we still kind of expect soybean oil prices to remain well supported. We still have problems in the Northern Plains, and there are still substantial questions about the size of the Canadian canola crop, which will translate into canola oil. And the US canola crop was cut substantially in last month's WASDE report. And so the total supply of veg oils in the US and more broadly in North America is going to be lower and maybe substantially lower than we all thought it was going to be 6 months ago. So that should tend to support prices, especially even without CVR. We still expect a pretty substantial increase in renewable diesel capacity coming online in the fourth quarter of 2021 and then in the first quarter of 2022. That still all seems like it's bullish to me. And beyond that, then I think that what you've had is sort of a series of news announcements that have been bearish, or uncertainty, which is always kind of generally bearish. And I think the soybean oil market at 60 cents for the December contract, or slightly below 60 cents for the December contract, had largely priced a lot of that in. And so I think that doesn't necessarily mean that soybean prices can't fall a little bit further, but I think we probably have plumbed the depths of the lower end of the trading range, at least over the next several months. And that's kind of what our forecast suggests. I think the next real opportunity for a substantial break in soybean oil prices will come with the Brazilian crop. If Brazil gets its crop in a timely manner this year and early season growing conditions are good, then I think that you probably could have a break across the soy complex, and that would tend to drag soybean oil prices down. That's part of why we kind of have soybean oil prices kind of trending lower after December. That gives us enough time to get early indications of what Brazil looks like, how much acreage expansion there's going to be, and what the early season weather is going to look like. And assuming all of that is normal, we kind of expect prices to trend down. But again, probably relatively slowly, since there's going to be, we expect there to be robust domestic demand based on the expansion in renewable diesel, but also in non-biofuel, which continues to be stronger than we have expected. And so all of that is going to make any decline kind of not the types of declines that we've seen in recent years when soybean oil prices have tended to fall off a cliff after rallying a bit. On to this week. So this week we'll get the August WASDE report. We still, as I pointed out in the commentary, our biggest deviation from USDA's predictions remain in biofuel and non-biofuel demand, both for old crop 2020, 2021 and new crop 21, 22. But we still do kind of expect, in the CVR announcement kind of underlines it, we expect that the ultimate number is probably somewhere in the middle. When we get to the biodiesel section, I'll talk a little bit about what the impact that the CVR announcement had on our capacity utilization projections going forward, and we'll talk a little bit about that. That's really the way that that ultimately we would end up adjusting our forecast lower. Of course, every month we get some data, and that can also adjust our forecast a little bit lower. But right now, just based on CVR, we haven't really cut that much out of our forecast. We've just changed basically the utilization rates, because our biofuel production forecast comes from a different source. We don't sort of add up all of the capacity and then forecast production based on capacity. We certainly take capacity utilization into account when we forecast, but that's not necessarily what drives the forecast anyway. So we do expect there to be some movement lower probably on our end, and potentially higher on USDA's end. You can see last month they cut 200 million pounds out of their prediction. If you just look at the data from the EIA, the most recent data for the EIA, the pace that the monthly pace of soybean oil usage suggests something that is higher than USDA's number, assuming that pace continues going forward. That may be a big assumption, but assuming that pace goes forward. And so ultimately, I think they're going to have to come up a little bit. Next year, there's obviously a much bigger gap with the lack of guidance from the EPA on mandates. I think that significantly bigger gap is going to persist probably for a while, and until we get into next year and start to see how much of the expansion occurs, whether there are new plants that are idled or plants that are delayed, that kind of thing. But until we start to get some of that information, we're just working with the best information that we have now, and that leaves us with a big gap. USDA offsets that gap, or offsets the lower biofuel demand with higher non-biofuel demand. And I think that's fair. And I think that, you know, if or as we come down in our forecast for soybean oil usage and renewable diesel production, or biofuel production more broadly, then it's not like that's going to fall to ending stocks. It is going to fall directly into non-biofuel usage. You can see the sharp decline that we've got built into our balance sheets from the old crop to the new crop. And that's just not, I'll be very, very frank, that's just not reality, but it's the number that we need right now to make this all seem somewhat reasonable. The reason that we have these calls is so I can explain that to you, and you don't think that I'm just crazy and think that this number is actually going to be true. It is my best effort at this moment, and I understand that that this number, the biofuel number is probably going to be a little bit lower in feed and fuel, or food, feed, and industrial, probably a little bit higher. That's certainly the experience that we had this year, where we started off with a relatively low non-biofuel number and have ended up at several billion pounds above where we started the year. That will leave ending stocks close to where we are now, maybe a little bit tighter, maybe a little bit more, but I don't think we'll get above sort of 2 billion pounds. I'd be really surprised if we got close to 2 billion pounds, unless the US soybean crop is just a huge bumper crop that is much bigger than expectations are right now. And given the growing conditions in North Dakota and in the Northern Plains, I don't think that that's necessarily true. In terms of expectations for this report, I think the one change that I might bet a little bit on is in exports. USDA cut their exports a little bit by 125 million pounds last month. That left them a little bit lower than where we are currently. But last week we got census data for June that came in a bit above our expectation. It came in at 91 million pounds versus our expectation of 75 million pounds. And if you look at the last quarter of the year, even if stocks are tight, even if we ship at a slower rate than we shipped in June, which we think is what's going to happen, it still is tough to get much below 1.8 billion pounds. And so in theory, maybe they would raise a little bit, but I don't expect them to make a significant adjustment there. On to canola. For canola oil, USDA tends not to make a bunch of changes month to month. They obviously made some changes last month. That was in part due to the change in their estimate of the US crop. If they change their crop estimate again this month, then maybe they'll make some more changes. But I wouldn't necessarily be surprised if there weren't any real significant changes in their US canola oil balance sheets. Here, we're not, really the biggest difference is in our forecast for imports next year. Those obviously primarily come from Canada. And given the state of the Canadian crop, we are lower, and I'll show you this in just a second, we're lower on Canadian exports than USDA. That translates into lower imports. USDA has been surprisingly sort of stubborn about lowering their US import number, given what we sort of already know about the Canadian crop. So it wouldn't surprise me if they left their import number unchanged this month, and it wouldn't surprise me if they lowered it a little bit this month. I don't have a really strong feeling that they will lower it, just because they have been kind of slow to lower it. But there is that potential, and ultimately I think that they're going to need to do that. For Canada, let's start with Canada canola. Again, the big question remains this number here, production, 19 million tons. When we made the change several weeks ago, seemed like a big cut. Now it seems like it's probably the upper end of the range. It will be interesting again to see what USDA does, if anything, to their Canadian production number. But if they lower it, then that translates into changes in their exports of Canadian seed and also Canadian canola oil exports. I think that if they do ultimately lower it, I think they probably will sort of adopt the same changes that we have, which is a relatively larger cut in exports than in crush. Again, given the strong demand for veg oils in North America in 21-22, and the smaller supply of oil seeds and ultimately vegetable oil, it just makes more sense that they probably will cut the offset the cut in production with a reduction in their export forecast. I would be really, really surprised if they took too much out of crush, but they might take a little bit out of crush ultimately. For canola oil, again, here you can see right now we're a couple of 100 million pounds below USDA on total supply, and that translates into a little bit lower exports. We've got growth in domestic use, and Canadian canola oil domestic use this year looks like it's record large, and we expect it to kind of continue to grow a bit next year. Our number might be a little bit optimistic, but I think USDA is probably a little bit pessimistic, and I think, again, ultimately we probably end up somewhere in the middle, probably closer to this year's number maybe than our forecast. But right now we just kind of, if we're looking out towards next year, we think that there's just a little bit of growth from again the record levels that we saw this year. And then again, we're about 100 million pounds below USDA on exports. That, however, if we cut our forecast for Canadian canola production, we probably that will ultimately maybe reduce crush a little bit, and probably ultimately that translates into a little bit larger reduction in canola oil exports, especially if domestic use is going to remain at sort of these close to or at record levels. For Canadian canola cash prices, again, we still expect these to be really, really strong and reach record levels. We don't really expect there to be much let up in cash prices for canola oil, primarily because of the shortfall in production, but also the potential for USDA to approve a canola oil pathway either late in the fourth quarter of this year or early in the first quarter of 2022 that will increase canola oil usage and renewable diesel production. Probably not by a lot. I think I've talked about this a couple of times. I think mostly that goes into some of the West Coast markets. But I think the relatively bullish canola oil balance sheets compared to soybean oil, that kind of explains why you don't see the same kind of break in canola oil prices that we've got built into soybean oil. You kind of just see the chart go up and to the right, and we may be off a little bit on how high prices go, but I will be more surprised than anything if canola oil prices were to remain weak, or even honestly if they were to remain below $1 a pound for a significant portion of the 2021-2022 marketing year. On to palm oil. This week we will get the monthly Malaysian Palm Oil Board supply and demand estimates. There really isn't that much that's exciting that's going on this month. The big questions really remain what they have been, which is when do exports start to tick up? When do India and China start to restock after a period of sort of below normal shipments or lower than expected shipments anyway? India is fully through the Delta wave of the coronavirus, and it's been a little bit surprising that shipments to India haven't been a little bit stronger. cargo surveyor data for the first 10 days of August were relatively weak, and I think India has to come back at some point, but I've thought that for a little while now, and they haven't come back yet. So I'm not going to make any predictions on when they come back. I just know at some point they're going to have to come back. China seems to be just starting up the Delta wave slope, and so even if you do get India to come back at this point, I think you're probably in for a period of maybe relatively weak shipments to China, and so that's going to weigh a little bit on Malaysian futures. With that said, Malaysia is also sort of heading up the Delta slope, and so there've got to be questions about production, not only from just a number of cases and the potential for an extension of lockdowns or the reimposition of lockdowns or those kinds of things, but also because the Malaysian industry relies heavily on migrant labor. There's been some issues with international travel, obviously, and so even if they get beyond that Delta wave without lockdowns or any kind of restrictions on capacity for processors, that kind of thing, finding enough workers to go out and harvest the palm fruit is going to remain a problem for a while. That's why palm oil prices are close to record highs, and we expect that that's probably going to stick around for a little while. We also don't really expect to get back close to that sort of magic 2 million ton level, which is, at least, anecdotally, the difference between bullish palm oil prices and bearish palm oil prices. And so we've got palm oil prices remaining kind of where we are, but not necessarily dropping. Not exactly sure what causes all of this volatility in here. I would have to look into that a little bit deeper to check that out, but there's nothing specific that comes to mind, and this should probably be smoothed out a little bit. When I did these predictions last night, I didn't really have I didn't look at them as closely as I should have, obviously, but yeah, we should probably be a little bit smoother, maybe at a little bit lower level, but much like soybean oil and really the world vegetable oil market more broadly, bullish fundamentals are going to continue to underlie the market for at least the next several months and maybe the foreseeable future, depending a lot on what soybean production looks like in South America in the upcoming year. On to biodiesel. So the first thing that I want to talk about is just this chart here, and again, the implications from sort of taking CVR out of our plant list, or effectively zeroing out their capacity. You can see that makes capacity run a little bit higher going forward than we have historically, than capacity that has been reported. And then we kind of drop back down and come back. This drop down is why we haven't really made a big change to our production forecasts as of yet. If we get more announcements and our capacity utilization goes up and is above 100 for the whole 12 months going forward, or whatever, in the next 2 years, whatever period you want to look at, then we would start to adjust our production forecast based just on the fact that, hey, if you look at what we're saying we're going to produce, it's just tough to reconcile that against capacity. Right now, we're close enough that we don't think we'd really need to make any significant changes. We'll see how the next couple of months of EMTS data looks, and then we'll probably make some changes based on where we were before we get the EMTS data and what the EMTS data says. Or again, if we get 2 more announcements and capacity utilization is up around 120% in a straight line going forward, then we would also obviously cut our production forecast. But for right now, this is close to the level that I would suggest we might need to make a change, but it's just not quite there yet. And so we're kind of in wait and see mode. For gross margins, this chart still doesn't look right because I looked at this last night when I published this. I think we've got another situation here where this chart didn't refresh. So apologies for that, and check back with this chart later today. I'll have Wei refresh this chart because I looked specifically to see whether this was still there, and I did not see this last night when I was publishing these. That said, our forecast for gross margins right now, just without credits, is a little bit trending a little bit lower. That's due in part to the recent weakness that we've seen in energy prices. So our forward energy price forecasts have come down a little bit. And then a lot of our feedstock forecasts are a little bit higher than levels that we're seeing right now. And so that we think will kind of continue to pressure margins. Energy prices are recovering today, and so if energy prices continue to recover, then that would be enough to offset potentially the increases that we see in feedstocks. If not, if energy prices turn around and start to go back down because of concerns about the Delta variant in China, then we will probably lower our margin forecast. Probably will go lower. With credits, though, you can see we expect ultimately that that we'll get to a level where biodiesel gets back above the 0 line, and we expect that that renewable diesel will start to pick up. That is due in part to our RIN forecast. And so if you look at our RIN forecast, we expect RIN prices to remain relatively strong. Certainly, while there are while there's uncertainty about the mandates, that is going to remain strong. And so I think that getting the mandates would be one thing that would potentially lower the concerns about the blend wall, and that could ultimately drive a break in prices. But until we get those mandates, again, concerns about the ethanol blend wall are going to continue to support prices. The other thing that potentially could support prices, and we talked a little bit about this in the commentary, is this idea that the RIN bank might draw down to 0 early in 2022, or I make the argument that even if it's late in 2022, the market's going to kind of sniff that out. And in RIN prices, then our RIN price forecast probably is going to look very modest compared to what RIN prices would actually do if the market thinks that we're going to run out of RINs. Now, all of that said, we have started to dig into the RIN bank, and what I found, at least initially, it seems like this all started because of some comments that were made on BIOF Energy's earnings call, where their CEO said that he thought that there was a potential for the RIN bank to run out of excess RINs again in early 2022, or by the end of 2022. it looks like to me the initial starting point that he was using was maybe a little bit lower than the actual size of the RIN bank. However, there is a big question about sort of unmet mandates at the company levels. And so we've all heard about Delta Airlines and the compliance deficit that they've carried forward. PBF apparently has a relatively large mandate deficit that they're carrying forward. It's tough to know exactly what those are. And so their number, which is, I think, lower than where the RIN bank is, may include those deficits and assume that people are going to need to satisfy those deficits at the end of 2021. In that case, then they might be, his statement might be closer to the truth than what it looks like just from, again, early research that we've done. We're going to continue to dig into this, and probably by the next time we talk, I will either have written an article about it or we'll talk about it on our next call. Let's see. Finally, LCFS credit prices. They've come down a little bit, but seem to have stabilized around 180 and maybe our turnaround. And we expect them to kind of remain in this range and then maybe slowly creep higher in 2022. There's no real big change there. All right. With that, we'll go to questions, and sorry for the big crazy pause there. I was thrown off by, I'm not exactly sure why my background changed, but there you go. Okay, so the first question is, you are forecasting a large growth in biofuel production, which will significantly increase RIN and LCFS credit supply. So why are you forecasting these credit prices will be so high in 2022? Shouldn't a rise in RIN availability reduce their price at some point? So again, this all goes back to what drives RIN prices higher. It's not as straightforward as supply and demand. Supply and demand obviously plays a big part in it, but because the RINs are nested, that means that D4 RINs can actually satisfy the requirements, especially if the ethanol mandate is not met. Right now, we're forecasting about a 1 billion gallon shortfall in ethanol production relative to the mandate, assuming that the mandate remains at 15 billion gallons. And so if you have a 1 billion gallon shortfall, then essentially you need a billion D4 RINs to meet that mandate. And that's why RIN prices that's part of the reason why RIN prices are so high right now. And until we get some clarity on the mandates going forward, all we can do is kind of make our guess and some assumptions about what the mandate levels will be. And our guess right now is that the concerns about the ethanol blend wall continue into 2022, especially if we don't have mandates. And so that will tend to support RIN prices kind of no matter what the supply is. At some point, if we get really a lot of excess production, let's say that every renewable diesel producer that has even thought about producing comes online and starts to produce, and we get no rationalization of biodiesel capacity, and we're just producing way over, and then the mandates coming out are substantially below everybody's expectation. In that situation, then I think you could see a big break in RIN prices. But conversely, like I said, if there are real concerns about the RIN bank drawing down to zero, then I think that you're going to see RIN prices remain really well supported and probably above our forecast until there's some real certainty around what those numbers are. Now, as anybody that's tried to forecast the RIN bank can tell you, it's a really, really tough thing to do. I've taken several runs at it, and I've talked to the person at the EPA that does sort of the end of the year reconciliation about forecasting it. He even admitted that trying to forecast the RIN bank was nearly impossible. And so there will be a lot of uncertainty about the size of the RIN bank. And now that that this idea that the RIN bank might draw down pretty substantially is out in the market, I think it's going to be really tough to break RIN prices because of that and the concerns about the ethanol blend walls. Somebody says, I apologize, I had connection issues when you're speaking about CVR. Could I briefly repeat? So CVR Energy announced on their quarterly earnings call that they were going to pause production at the plant that is open, and they were going to pause the development of their second plant. So essentially we zeroed out CVR Energy. They were a facility that used a lot of soybean oil. And so in theory, that should weaken the soybean oil demand for biofuel usage. But since we didn't really make any big changes in our forecast for biofuel production, and in kind of the way that we calculate biofuel usage or feedstock usage is on a percentage of the total needed feedstocks. There was a very small change in that. It didn't really have a significant impact on our soybean oil use in biofuel production predictions. All right. Let's see, can I speak to the price differential between crude and refined oil prices? The difference between the two seems to have increased recently. So I'm thinking this is vegetable oils. I'm sure it is. This is a call about vegetable oils. There is a lack of refining capacity for vegetable oils in the US. If you look at what our estimate of refining capacity is versus what's been produced, even our estimate of refining capacity falls a little bit short of the actual production numbers that we get from USDA every month. And so we believe that probably the capacity that's out there is either working extra shifts or somehow working a little bit above. There's also some refining capacity or pre-treatment capacity at some of the newer renewable diesel facilities. And that's what's really driving the spread between crude and refined. You have more demand for refined than we've had for a while because of the new renewable diesel plants coming online. And those guys are getting out and starting to source feedstocks for production. And you have kind of static capacity. There is going to be capacity expansion. And Cargill has made announcements that they're going to expand capacity at all of their plants, and there have been other announcements of expansions or new plants. That said, if I'm Cargill, I'm making that announcement and I'm expanding capacity, but I'm not really cracking the whip to get the expansion done, because right now I'm making a huge margin on the spread between crude and refined oil. And once that goes away, it probably will be a couple of years before they get another shot at it. We expect that the industry will build enough capacity so that they've got a little bit of spare capacity, but not that much over the next couple of years, and that will calm the spread back down again. But then as renewable diesel capacity continues to increase in the US, we'll get back to this situation in a couple of years' time. So you probably have a couple of years of this spread going forward. And I know that there's going to be some expansion next year, next fall, really. But you probably have 2 years, I would say, at least, of just call it elevated spread between crude and refined. Then it probably comes back to its long-term average for a couple of years, and then it probably blows out again. And then when it blows out again, you get another expansion, and you probably have a couple of these cycles to go through before we get to kind of a longer term equilibrium. But it's really the spread is really about the new renewable diesel capacity that's coming online, and the fact that they're actually starting to source refined soybean oil right now. Now, the other part of this is a lot of the new renewable diesel producers are starting to consider whether to put that refining and pretreatment capacity on at the front of their plant. I think that will also help relieve some of the pressure. But again, I think that solution is probably a year or two away before we start to see the spread come back to kind of its normal long-term average. To your comment about the RIN bank drawing down, do you have a RnSMD? Is it available to subscribers? So again, what we do is what we've done in the past, I guess is what I should say, is the EPA essentially published a reconciliation of the RIN bank at the end of the year. And we kind of looked at that and copied that, and to make sure that our RIN bank kind of aligned with what they were saying, obviously. And then we tried to project it forward. We're never really able to project it forward for several reasons. One of them is this idea that some companies are carrying these compliance deficits. And so you have some usage of RINs that is really, really hard or basically impossible to predict. So it's almost impossible to kind of project a RIN balance sheet going forward. And so once we hit that point, I kind of thought, okay, well, we've got a lot of excess RINs, and it doesn't look like we're going to draw the RIN bank down. And so I kind of set that aside, and I haven't really reconciled our RnSMD with the EPA's memos in a couple of years. And so that's the process that I'm going through right now. Once I do that, I'll be happy to share the results of that on this call. I will probably publish it in the weekly report as a table in the biodiesel section. And then if you want to, once I publish it, if you want to reach out to me and ask me some questions and talk about it, please feel free to do so. I'd be happy to answer any questions that you have. But right now, we don't necessarily have one. Would the impact be if D4 RINs being used for D6? Are there excess D4 RINs with those prices align? So that's kind of what we were talking about before. Every year, we basically go through and we calculate something called the undifferentiated advanced requirement. And what that is because cellulosic production, basically D3 RINs, have not kept up with the pace, the growth that was originally envisioned when they passed the law, there is a shortfall between the D5 mandate and the sum of D4 and D3. And the D5 can be met with D4 RINs. It can also be met with ethanol imports, sugarcane ethanol imports from Brazil. And so essentially what we do is we go through and we look at, okay, what do we think D3 production is going to be? What do we think D4 production is going to be? Now we get the sum of the difference between the sum of those and the D5 mandate gives us an initial cut at the undifferentiated advanced biofuel mandate. Beyond that, then we look at what we expect Brazilian ethanol imports to be, and that gives us our final undifferentiated advanced. We add that back to D4, and so that effectively increases the D4 mandate from whatever it is to whatever it is plus this undifferentiated advanced. Now, if we have a shortfall in ethanol production, then that leads to a shortfall in the overall mandate. And since D4 can be used to meet the overall mandate, that's where this ethanol blend wall concept comes in. So this year, again, we're projecting ethanol production at about 14 billion gallons, about a billion short of the 15 billion gallon mandate. So whatever we have for the undifferentiated advanced biofuel mandate, now we need to add another billion gallons for the ethanol blend wall concerns. And so that those two things, what tends to happen then is D6 prices rise, but D4 prices rise even more, although that spread between them narrows. They don't trade in alignment with each other perfectly because there's always going to be more demand for D4, I suppose, but that spread does tend to narrow down a little bit, and that's why why you're seeing RIN prices where they are today, but two, why you're seeing the spread between D4 prices and D6 prices in our forecast is relatively narrow compared to where it has been at other times in history. So they don't quite align, but the spread does narrow and prices go up. Now, the impact of essentially drawing the RIN bank down to zero is sort of unknown territory, but I think it's safe to say that it generally means much higher RIN prices. All right, where can I download the replay on this session? I will have to get with George and ask him where he posts this. If you will send me an email at Tore.Alden, ALDEN, at fastmarkets.com. Just so I remember to do this, I will get with George and I will get an address for you so that you can find a spot. You can find the spot to get the replay of this session. All right. Okay, I think that was it. Thank you everybody for attending. Sorry for the kind of weirdness there in the middle. We will see you all next week, and then hopefully we'll see quite a few of you at the Jacobson conference that's coming up in just a couple of weeks. On that Tuesday, actually, I'm going to be traveling. I don't know if Ryan is going to travel or not, so we'll work it out. If Ryan is going to be available on that Tuesday, we'll have this call on that Tuesday. If he's not going to be available that Tuesday, we may skip this the week of our conference, which is not next Tuesday, but the following Tuesday. Again, thanks everybody for attending. Have a great day.